In this video, we'll cover perpetual swaps, also known as perpetual contracts. Let's begin with looking at how cryptocurrency perpetual trading differs from spot trading. When most of your friends tell you they bought or sold cryptocurrency using an exchange, they're most likely referring to spot trading. Cryptocurrency spot trading is the process of buying and selling digital assets such as Bitcoin and Ethereum for immediate delivery. Using the example of purchasing Ethereum, if you buy 1 ETH on the spot market, you actually own 1 ETH. When you own a digital asset directly, you can derive a multitude of secondary streams of revenue, such as staking it, or use it for utility in the form of voting or governance. However, crypto spot trading has the drawback that traders can only hold long positions on their purchased crypto assets. This means that the trader only benefits from capital appreciation, as the value of their cryptocurrency increases over time. In contrast, perpetual trading allows traders the option to hold long positions or short positions on an underlying crypto asset. This is one of the reasons why perpetual trading is gaining popularity among crypto traders. Perpetuals are a form of derivative, a financial contract that allows you to use USDC as collateral to speculate on an asset's price movement, with leverage and in perpetuity, as there's no expiration date on the contract. With perpetual trading, you can take advantage of price volatility. Regardless of whether prices rise or fall, perpetual trading enables you to participate in a cryptocurrency's price movements with ease. If you expect the value of an asset to go up, you buy a perpetual contract to go long, and if you expect it to fall, you buy a short contract. Your profit, or your loss, will depend on the outcome of your prediction. In other words, you can speculate on a cryptocurrency's price rather than buying the underlying asset itself. To recap, let's go over some important advantages that perpetual trading has over spot trading. First, by allowing for leverage of your underlying USDC collateral, you can improve your capital efficiency. 1 Bitcoin USDC of value can be leveraged to purchase contracts that represent up to 20 Bitcoin. While this gives you the potential to maximize profit, you should always be aware that the higher the leverage, the greater the risk of your position being liquidated. Second, perpetuals allow you to go long or short on assets. A trader is able to make money by correctly predicting the price direction, up or down, of the underlying asset. And finally, unlike traditional options, perpetual contracts have no expiration date. Another key feature of perpetual contracts is their ability to closely track the price of the underlying asset. This is achieved through the funding rate. Funding payments are used to incentivize the price of the perpetual to trade as closely as possible to the price of the underlying asset. You can think of it as either a fee or a rebate for traders to hold positions. This mechanism balances buyer and seller demand for the perpetual contract so that its price falls in line with the underlying asset. This is better illustrated using the following diagram. This chart shows the graph of an asset's price and the price range of a perpetual contract for that asset. When a perpetual is trading above the price of the underlying asset, depicted in green, the funding rate is said to be positive, and long traders pay short traders a fee, incentivizing selling and lowering the contract price to fall in line with the underlying asset. If a perpetual is trading below the asset price, in the red area of the chart, the funding rate is negative, and short traders pay a rebate to long traders, thus incentivizing the price of the perpetual contract to rise. The frequency of funding rate payments and fees differ depending on the exchange platform. On dYdX, funding rates are updated every hour, but is represented as an 8-hour rate, indicating the amount of funding accounts may expect to pay or receive over an 8-hour period. These payments are exchanged solely between traders and are neither paid nor received by the exchange. The important takeaway is that a perpetual contract fundamentally stays in line by balancing supply and demand through fees and rebates paid between traders. If the price of the perpetual is close to spot, the rate needed to bring it back into line is small. The farther the price of the contract gets from the underlying asset, the higher the rate. In this video, we explained perpetual trading and its potential advantages over spot trading. We also covered how funding rates are used to keep the price of a perpetual contract closely correlated to the underlying asset. In our next video, we'll cover the fundamentals of market orders and demonstrate how they can be used to set up and close a leveraged position.